here today talking to you guys about an amazing strategy. I'm talking about investing where you can't lose. I'm talking about investing in public equities. Equities that are trading in capital markets across the world. And I'm talking about a strategy that's going to allow you to never lose money ever. Never. You cannot lose money with this strategy. It is nearly impossible. Let's get into the details about why. So, a couple key points. First thing is, diversification is the cornerstone of this strategy. And in fact, this strategy itself is the cornerstone of my own early retirement. I used this strategy to ensure that I would never have to go back to work, because if you can rely on a portfolio to increase over time and never lose your principal no matter what, then you are guaranteed to never have to go back to work. And that's why there are so many people on the internet today that are retiring in their 20s, 30s, and 40s and relying on this strategy right here. They're bogleheads, they're index investors. There, I said it. I'm going to talk to you guys about why this makes sense. So why can you never lose money? If you take a pile of money, let's call it your entire retirement portfolio, and you invest it in index or ETF, exchange traded funds, in ETFs, right? Diversified ETFs, then you cannot lose money if you do it properly. And here's the big caveat. The idea is this. You take your pile of money, your money minions, and you employ them. You buy tiny shares, tiny portions, tiny fractions of almost every company in the entire world. You're going to buy companies in BRIC, Brazil, Russia, India, China, emerging markets, right? You're going to be buying pieces of companies on the S&P 500, for instance, index, from the Toronto Stock Exchange, for instance. Every country, all of Europe, there are many different pieces of companies you want to buy. The idea is this: if you buy tiny pieces of every single company in the entire world, right? Pieces of every single index, unless we have a global catastrophe wherein financial markets crash, you will not lose money. And in fact, I would argue if that's happening, we have bigger problems. People are going to be raiding streets. They'll be, the world will be collapsing. And at that point, you don't care that your portfolio is taking a dip. If the world continues to remain civilized and remain such that there are capital markets, you will not lose with this strategy in the long term. And this is the key piece, in the long term. And here's why. If you look at the data, I got a chart right here where I've got time on the x-axis. On the y-axis, we have dollar or value of said average companies. This works pretty much every index, and the S&P 500, Toronto Stock Exchange, many of the different exchanges and almost all of the capital markets, assuming the country hasn't gone to shit. If it has, then then that's why you're diversified in every single country. You don't own. A majority of your portfolio is never in one nation. You don't invest all in the S&P 500, because then you're relying on the United States to continue on as it has, to continue growing. You don't invest all in Canada. You don't invest all in Europe, and all in China, all in Russia, India. You have to diversify. Own a tiny piece of every single stock, ideally, pretty much every major stock or every mid-cap stock in the world. And you can do this by buying a series of different ETFs. You could buy 100 different ETFs that each hold 1,000 different companies. And the idea behind the ETF is that an ETF, you put a dollar in the ETF, and the ETF then takes your dollar, and they take that dollar, right? And they buy 100 different companies at a penny each. So you own a fractal piece of a share that's owned by this exchange traded fund, so an ETF. Index investing is amazing. If you use it properly and you're properly diversified, you rely on the thing. It's not about timing the market, it's about time in the market. And so the longer you're in the market, the better you will do. Now we can track, this is a long period of time, and you're going to say, hey Mike, you know what? My aunt lost everything in 2008, or in 1991, or whatever, in 1977, they lost everything. And you know what? It's because they weren't diversified investors. They weren't following the strategy. If you have all of your money in North American index funds, right, all in North American ETFs, all in North American companies, you're relying on Canada and the US, and if it's North America, Mexico as well, to do well. And that doesn't make sense to me, because you got to think about it. What is the chance the US could fall? I mean, not very high, but it could still happen, right? You're still taking risk. The only way to consistently guarantee around a 7 or 8% return and eliminate almost all risk is to buy tiny fractal pieces of every company everywhere. This is what this is what happens over time to the average of all of the companies, right? Some companies are failing, they're going to zero, they're going bankrupt. Some companies are doing really, really well. But on average, what we see, the data suggests about 7 to 8% growth every single year since like the 1800s. In fact, we've had years with way more. Some years it's down 10%, some years it's up 20, right? But on average, you get about 7.8% a year. And you can see right here, if you bought at the high point, let's call this 2007, 2008, it may have taken you 4 or 5 years for your portfolio to recover, right? Because you might have had a decent percentage of your portfolio in US equities. But if you just hold, time heals all wounds with this strategy. You cannot lose your capital unless you sell. So you don't lose until you sell. That's the key piece here. If you hold over the long term, your portfolio will rise. Within 5 to 10 years, you will always double your money again and again and again. The rule of 72, right? If you divide, anyway, so I'll go into another video about that. I don't want to muddy this video with that, but the idea being that you can grow your capital guaranteed. This strategy, and no matter what, no matter how volatile the market is, if you only own a small fractal percentage of that volatile company and you own thousands of other companies, you are diversified. And I want to make one clear distinction that I like to modify this strategy ever so slightly, because I rely on passive income to live. I rely on some of my portfolio. I need to withdraw on some of that, right? And if you need to sell shares, you'll create capital gains to live off that money. That's not really a stable way to withdraw from your portfolio. I would say leave the portfolio to grow and withdraw the dividends, right? The piece that really is paid out by the companies on a quarterly, annual basis, right? Dividends are essentially the profit that's left over, right, in the retained earnings. Companies will pay out on a quarterly basis to their shareholders, right? So they have a choice. They can use the retained earnings to invest back in the business, or they can pay out a dividend. A lot of companies are established and they prefer to keep their shareholders happy by paying out dividends. And so dividends are being paid out. And in fact, people say, well, how do I hold? I bought in 2007. How do I hold until 2010 when things recover? How do I hold for that 3 years while I'm underwater? I need that money to live. I've retired, Mike. I need to rely on that income. And I'll tell you what, this is what I would do. I would buy into ETF portfolios that also pay dividends. So a percentage of your portfolio that's paying dividends. And most companies, if you look at the data, back following in that time of recession, most of the companies barely cut their dividend and kept paying it throughout the recession. Despite prices dropping 20, 30%, the majority of companies continued to pay a dividend. So what you see is dividends tend to increase when companies are having really extremely profitable years. And in not so profitable years, they can cut the dividend, right? They can slash the dividend. But typically, if you look at the data, companies tend to remain about flat on their dividends. So dividend yield, the rate you're getting to the price of the stock, right? Like the amount of dividends you're getting to the price of the stock, the dividend yield tends to actually increase in times of recession, such that the amount of raw dividends you're getting are about the same as you were getting before. Despite your portfolio dropping in value, the yield on the dividend is rising typically. And so the result is that you continue to collect dividends. And so most people, this is the dividend line, you can see what dividends do, right? They go up in chunks on average, right? They tend to remain relatively flat during times of recession. So if you have a proper diversified portfolio, you can still withdraw some, as long as and I also recommend in this ideal portfolio, if you want to live on it for the rest of your life and withdraw passive income from that, you're going to want to have 1 to 2 years emergency expenses. Call them, your 2 years of annual expenses. Call it an emergency fund, emergency expenses. And a high interest savings account of like 2.6%. There's tons of those. I can link to some of those. If you guys ask in the comments, asking about that, I'll tell you about in Canada, how you can just throw money in a high interest savings account in Canada and get like 2.6% return, which will combat and beat inflation. So that's what I would recommend. It's still growing faster than inflation. Your money isn't being eaten away by inflation. And at the end of the day, this is why it's really, really important. So I know it's a bit long-winded, but diversification is the most important thing. Diversification. You want multiple different fractal ownerships of many shares. You want to be an index investor. You want to be an ETF investor. And John Bogle, founder of Vanguard, was one of the guys who started this whole movement. And that's why I call myself a Boglehead in some ways, because I'm very much obsessed with his way of investing. It is the ultimate way of investing, I think, because when you own fractal ownership of many different companies across the entire world, even if the United States has a bomb dropped on it and it's gone, right? You haven't lost all your money, right? Those companies might, some of those, US equities will not perform very well, obviously, But because you don't own a major share in any one country, in any one company, in any one index, you're so diversified, you can't lose. That's the key piece. You don't want to lose money. When you've worked really, really hard to save whatever it is to reach retirement, or any money you've earned, you don't want to lose that. So that's why I like this strategy the very most. It's not going to get you 20, 30, 40, 50, 60, 100% return on investment. No, it's not. It's not like real estate where you can put in active time. It is a passive strategy. You are not actively trading stocks. You're buying these ETFs, these series of, say, 25 ETFs. They each hold series of different companies. And you're rebalancing, say, once a year. It's a very minimal effort, minimal time strategy. It's a very minimalist type approach to investing. And that's what's really great about it, is for those people who don't want the stress, they don't want the headache, they might want to build a real estate portfolio off, build it up, and then sell it off, right? And at the end of the day, take all those gains and put it in something like this. Something where you can guarantee you're not going to lose your money and you don't have to have any headaches, no calls. You can sit on a beach with no cell phone service and do whatever you want. That's the idea here, guys. So this video talking about diversification, time in the market, long-term markets always increase, right? On the average, on the aggregate, economies continue to grow, right? We have continual GDP growth. GDP continues to grow. Gross domestic product continues to grow in almost every country in the entire world. And the world indexes continue to grow at a rate of between 5 and 8%. Some markets growing faster, some growing slower in the world. Depends on the country, depends on certain geopolitical and economic factors in that country. I'm going to go through training in school to be able to sell mutual funds and things like that. So I'm not a big fan of mutual funds because they have high management expense ratios. ETFs have very low management expense ratios. The MER fee is like 0.1% instead of 2.5%. And over the long period of time, that's going to definitely impact your portfolio in a considerable way. In fact, like we're talking potentially the entire value of your portfolio over a 30-year span is lost to fees because it does one less double. At the end of the day, this is not legal advice. I am not a financial planner. I have done some financial planning, but don't take that as don't sue me, guys. This is just a strategy that people talk about. It does work. Take a look at the data for yourself. You can see that you can withdraw from a portfolio like this that's diversified. You can withdraw 4% a year for infinity and have like a 99% chance of never ever depleting the principal. At the end of the day, do not touch the principal. Only spend the interest. So that's what I got to say about index investing. That's what I have to say about a strategy that will allow you to invest and never lose money because you're diversified. If the real estate market crashes, you're fine. If a bomb drops on a country, you're fine. You are recession proof with this strategy as a long-term strategy, one that you want to have a long time horizon on your portfolio. You don't want to have to say, if you're putting in a strategy from a year from now, who knows what could happen in a year if you're going to sell out in a year and buy a house or something. This is not maybe the strategy for you, but in the long term, if you have a long time horizon, time will heal all wounds. So there you go, guys. As always, spend less, earn more, maximize your returns to unlock your wealth and become a richer you. What happens to your portfolio?
Up.
It goes up?
Yeah.
And then what happens? Does it go down?
Yeah.
Down?
Go.
We always want it to go higher! But the story of volatility. I know. We all want it to go higher. There it is. There, it's high. She's happy when it's high. But when it's down, she isn't happy.
No.
She wants it to go higher.